Happy Money Monday. We're back. Another Monday. Is this the last Monday of January? I'm not prepared. You can tell I'm not. Hi. Welcome, everyone. I'm Jayla. Money Mondays is time where I get live, I answer your questions, give you access to a financial advisor, certified financial advisor, and an attorney. Yes, I am that too. Let's get into it. Today is about risk management. I don't hear a lot of people talking about risk management, but another term for it, and you probably know it is this, is insurance. Yeah, we all have some form of interaction or non-interaction with insurance. So today, I just want to kind of talk about the various forms of insurance because there are life insurance, there's health insurance, there's disability insurance, there's business insurance, there's insurance there's home insurance and renter's insurance. So property and casualty, there's insurance for everything. And more important than having the policies is understanding the coverage that you have. And I don't think a lot of people know what's in their policies or know what's covered and what's not. So today's Money Monday is all about trying to help you figure out which types of insurance you may need at different ages of your life, and a plea to go get your policies and look at them and understand them and find out if you have the money for the elimination period saved, and make sure that you're prepared. So, and also when it comes to insurance, you really want to understand the tax consequences. A lot of people don't think about those. Depending on how you're paying the premiums is kind of determines how the insurance proceeds will be taxed. So, managing risk. Insurance is a contract. Deeper, insurance is a contract of adhesion. We're getting into legal terms there, but what that means is it's a take it or leave it contract. It's pretty one-sided. It's unilateral. You don't get a opportunity to change it. That's why you have to be very careful with insurance, because you don't get to negotiate it. And you know, attorneys, we like things you get to negotiate and change and make sure is in your best interest. Insurance, you can't do that. So, what types of insurance should you have at different ages? Hey, Jackie, thanks for stopping by. So while you're in what's called your accumulation phase, usually anywhere from your teenage years, and I have to say that because we got some teenage millionaires out there, to about age 45 to 50, you want to be looking at or have healthcare insurance, disability insurance, life insurance, property and casualty insurance. Emphasis on disability insurance, especially if you're working. Now, I know a lot of us don't like to think that something could potentially happen to us and we could not be able to go into our jobs, but that's what disability insurance is for. Very important for women, because this is normally what women use to go on maternity leave, because that is, pregnancy is technically a type of disability in most policies. So you want to make sure that you have a policy that covers you. And a lot of times you want to look at what percentage of your salary will be paid to you. Often it's like 50 or 60%. What does that look like for you? What can you do with that? Have a plan, because maternity leave can go out for a long time. You also want to know what the elimination period is. That's the period before they'll start paying your benefits to you. A lot of times, as a financial advisor, will advise you to put that money in your rainy day fund, so that you're ensuring that you're covered and before the insurance kicked in. So make sure when you're looking at your policy to also look at your rainy day funds, your emergency savings, and make sure you have that amount of money to cover the expenses for however long that period is. Hey, Octavia. Thanks for coming. So yeah, they also usually say that in that accumulation phase, you should have life insurance. It's way more important, the disability and the life insurance, to have that if you have dependents and if you have income that you need to have replaced. So I'm not an advisor that believes that life insurance should really be used to build wealth, because like I said, it's a contract of adhesion. It's not in your best interest. It's a take it or leave it contract. It can help you, and well, it'll help your family, because remember, it's life insurance on your life, so it's not going to help you very much. But I know there are contracts out there, there are insurance policies out there that they advertise. You're investing, you're paying them big fees to do that when you could just open your brokerage account and do it yourself. Buy and hold. Do exactly what they're going to do for you. I know they're the risk averse. Learn about the process. Believe me, and study and talk to your insurance advisors, your agents, and ask them about the fees. See the difference and go what's best for you. But when it comes to the life and disability insurance, you do want to make sure you're using it for its intended purpose, especially the life insurance. With me, take my situation, there are bills that I have that would continue if I was gone, if I had a job, if I was disabled or not. So I want to make sure to have coverage in the amount that's going to help keep my family paying those bills and help take care of my kid without interruption and not have to rely on just my savings. So that's what I would use disability insurance for, or life insurance for. It pays off the debt that I would have so that my child doesn't have to deal with it, and it doesn't affect her life. She can go on and do what she needs to do without having to worry about, well, mom left me in this situation. She said she was about generational wealth, but look like generational debt. That's not allowed. We're not doing that to her. So it's for an intended purpose. And I'm also investing so that she'll have other assets that she can pull from. When you get to about 45 to 60, your conservation / protection phase, where you start wanting to protect the wealth that you've built, although we are protecting our wealth right now. We're doing our estate planning, right? And that's when you more want to focus on your health insurance. You still want your disability insurance if you're still working, life insurance, and your property insurance or the casualty insurance. So making sure that your home is protected from perils, maybe a fire, windstorm, those type of things. Check your replacement costs. Make sure you understand your co-insurance on your property policies, because most of the time it's 80% of the replacement costs that they are going to pay for, and you have to pay the other 20% unless you have other riders. If you're not insured for the right replacement costs, you're going to get less. So do a thorough review of your policies, of your assets, to make sure that you will be covered. Same goes for health insurance. Make sure that you have in your rainy day fund that deductible amount, because that's the amount you're going to have to pay before the insurance company pays anything. And then after the deductible is paid, there's usually another co-insurance. So just like the property insurance I just mentioned, they pay a certain amount, you pay a certain amount until you hit your cap. Make sure you have that amount of money ready in case something happens. And around that 45 to 60 age is normally when people start looking into long-term care insurance. That's more of a protection against you not being able to perform 2 of 6 listed activities of daily life. So you're not being able to transfer from bed to chair, or walking, seeing, those type of things. But it has to be 2 of them. After those phases, you move on to what is called the distribution or the gifting phase, where you get very generous. 60 plus is about the age range. And the risk management you're doing there is just really ensuring that you still have enough money for health insurance and the co-insurances and the deductibles. You've already done your estate plan, but you're having it updated, and because this gifting phase lasts for the rest of your life and potentially beyond. If you have a trust, it'll last as long as you've set your trust to go for, until it achieves its purpose. And then you might have long-term care too, but you would have wanted to get it earlier because it gets more expensive as you get older. And that's with any insurance. So my advice today to you: find out your deductibles, find out what's excluded in your policies, find out your co-insurance requirements, your premiums, make sure you're paying those, make sure that they are up to date. And if you have an HSA, a health savings account, make sure that you're using those funds for your health-related expenses. But with risk management and with insurance, just make sure that you are prepared and that you understand your policy. If you don't, please feel free to reach out to a certified financial planner, as they would probably be the best person to go over individual details with you. I know I'm very, very adamant with my clients that they know their benefits, but if you're not in California, CFP is your best bet. I know some great ones in New York if you need a recommendation, and they can usually help you wherever you are. But that's it for Money Mondays, guys. Let me double check to see if we have any additional comments, concerns, problems before we go. So Nanny Marie says that she has the insurance through her 9-to-5, but wouldn't know how to source them as a self-employed person. That's huge on 2 levels. So most of the time, we normally have our health and our disability insurance, and sometimes group life insurance through our 9-to-5. That's wonderful. It's great while you're there. It terminates when you leave. So you can decide, I'm going to rely on that if you think you're going to be there for a long time. But if you think that you'll leave that job and you're getting up there in age, because like I said, it gets more expensive as you age, then you might want to have maybe outside insurance too. A lot of people do that with the life insurance, where they'll have their own policy, whether term life or whole life outside. With the disability, I want to say most insurance is regulated by each individual state. You can go to your state insurance commissioner, and they might be able to lead you in the direction, or at least let you know the companies that can help you get the disability insurance or the health insurance or the life insurance outside of your employer. But it is very important as sole proprietors, as business owners, to have the insurance. And there are a lot of companies that provide it. You just have to make sure that, like anybody, you're interviewing your advisors and making sure that you feel that they're acting in your best interests. Because, like I said, insurance already is not in your best interest. It is a contract of adhesion. It is, when you fill out that application, you are making an offer to them. but you don't get to negotiate it. They give you the contract. That's it. So be careful. And I think I kind of mentioned that businesses also have insurance. So as a small business owner, we're able to get business overhead expenses covered by insurance. So it's not going to cover you as the owner. If you get disabled, you're still going to need disability insurance, but it could cover in that situation where you're not able to work. It'll cover the expenses. It could cover employee salaries. It could cover like the month to month, the leases and stuff like that. So that's another business protection and managing risk of losing you and your valued contributions to your business. So I wish you luck, and I'm happy to have another self-employed person in the community. Thank you for the comment. If you need any help, I'm around. Happy Money Monday, guys.